Most people know the main option Greeks like delta, gamma, theta, and vega. But we're going to be focusing on gamma because if you understand gamma, then you understand how the market makers control the volatility in the markets. If you can get this down, you'll have a very big advantage in terms of intraday just looking at charts. So we all know about the four Greeks, but gamma is the additional gain to the delta per next dollar move. It's the compounding Greek, without accounting for IV, of course. So market makers sell many positions to retailers and just everyone throughout the day. If you want to buy calls because you think the stock is going up, a market maker probably sold you that position. Now, how do we determine if a market maker is selling or buying options? Well, that's all about positive and negative gamma, and you have to use GEX, the Gamma Exposure Index. So, gamma shows you how aggressively a market maker has to hedge. And this is important because it will show you the way the price is going to move, if it's going to be slower or faster. So indexes like SPY have market makers usually shorting puts, especially in bull markets. Well, that's just because the market's bullish in general. If it was the opposite way, it would be shorting calls, but it doesn't really matter because they're short both of the options at the same time, which is why I'm going to be mentioning gamma and that they're short the gamma or they're long the gamma. So use the Gamma Exposure Index. I personally just use Twitter. Somebody posts the Gamma Exposure Index for SPX every 15 to 30 minutes, and I use my eyes based on that. So if gamma is in positive territory, then the market makers are long, aka buying more options than they have their short. So if gamma is in the positive territory, then market makers have purchased more options than they have short. This is important because if there is positive gamma, you can expect slower moves, price pinning, dampening of volatility. Now, vice versa. So if gamma is in negative territory, then they're shorting the options. So this is where the opportunities of trading comes involved. People like you and me. So when the gamma is positive and SPX rises, the delta will rise because the options will rise, so the delta will gain value because of the gamma. This exposes the market maker's exposure, and it rapidly increases the rate at which they're exposed. Gamma is the speedometer for delta. So as SPX rises, delta rises. Market makers must sell shares to remain neutral, and vice versa. So that will dampen volatility. So if SPX rises and then delta rises and they're in positive gamma, they have to start selling shares. So you can see how that'll pin the price. Now, if SPX falls and the delta will fall, and the positive and the gamma is still positive, then the market makers will have to buy shares, once again creating the volatility dampening. Now here's where you get trading opportunities. Negative gamma. As SPX rises, delta rises, market makers must buy the shares to remain neutral. This amplifies the move and can create a directional trading opportunity. This is where you see violent squeezes and things of that sort. So let me get this straight to you. You have days like OPEX, option expiration, like for the quarterly, when market makers post the new option chain, the quarterly expiration and things like that. That's OPEX. So when liquidity thins, like near OPEX or near close or low volume, that's when those gamma levels become the biggest magnets. That's when you can expect price to be sticky and be attracted to these levels. So I'm going to give you an example of how you can use gamma, because now you know all of this. So let's say opening happens, right? The market opens, the market dips in the morning, and then the market starts to find a bottom, and then the price ticks up from that bottom. What's going to happen is if the market makers are in negative gamma, then you might see a squeeze faster, and it'll pump quicker, aka you can expect faster moves. Now, if that bottom comes intraday and the market makers are in positive gamma, if price begins to tick up, it'll simply have dampened the volatility, and you can expect price to move slower. You need to use the Gamma Exposure Index to determine if we're in positive or negative gamma, and that way you can see if market makers are shorting or buying options, and you can trade SPX accordingly. Otherwise, the charts don't tell you everything. So here's an example of something that you might see intraday that will be a great trading opportunity. Let's say the market starts to fall, and the market falls from positive to negative gamma, or it's just already in negative gamma. and the price creates a bottom. Let's say you're in negative gamma by 2 or 3 negative open interest strikes, meaning you're below 1 or 2 or 3 large open interest strikes in negative gamma. It doesn't matter if you're moving up or down. As long as you're in negative or positive gamma, you can still expect amplified moves in negative and dampened moves in positive, whether that's up or down. So here's a trading opportunity. Market opens, market falls. Market is in negative gamma, SPX. Let's say SPX negative gamma is 66.40. That's the level you're at. And there's also big negative gamma at 66.45 and 66.50 before it starts to flip to positive gamma. So price at 66.40 bottoms, ticks up, goes above 66.45. At that point, you can expect a giant squeeze to 66.50. That's how you can use gamma. Remember, this is not financial advice, but that's what you will see because the market makers are forced to hedge in that way. So targeting that next price area, it just makes sense because price is sticky around those areas, and then market makers are hedging aggressively to expect faster moves. That's how you can make more money with options, expecting the momentum. Does that make sense? In some of my next videos, I'll be talking about things like the wheel strategy, how to read flow, the things I look at. If you have any questions as well, you can always ask me. I'm open ears, and I definitely understand this a bit more than some of your favorite guru.